Today on Open Exam Prep, we're tackling a topic you are guaranteed to see on the Series 6 exam, the specific rules governing Roth IRAs. Let's start with the fundamental principle of a Roth IRA, which is that all contributions are made on an after-tax basis. This means you don't get a tax deduction for the money you put in, unlike a traditional IRA. For example, if a client contributes $6,000, their taxable income for that year is not reduced. The major benefit, and the reason clients love the Roth, comes on the back end. When they take money out in retirement, all qualified distributions are completely tax-free. This includes both the original contributions and all the investment growth over the years. So what makes a distribution qualified and therefore tax-free? This is a critical test point. There are two conditions that must be met. First, the account owner must be at least age 59 and a half. Second, the account must have been open for at least 5 years. This 5-year holding period is a frequent source of tricky exam questions. It's important to know that the clock starts on January 1st of the tax year for which the first contribution was made. For instance, if a client opens and funds their first Roth IRA in April of 2024, the 5-year clock starts on January 1st, 2024. But if they made that contribution for the prior tax year, 2023, the clock would have started on January 1st, 2023. An exam question might present a scenario where a 62-year-old takes a distribution from a Roth IRA they opened only 3 years ago. Even though they meet the age requirement, because the 5-year rule isn't met, the earnings portion of their distribution would be subject to ordinary income tax. Now, not everyone can contribute to a Roth IRA directly. The IRS sets income limits, known as Modified Adjusted Gross Income or MAGI limits. If a client's income is above a certain threshold, their ability to contribute is phased out and eventually eliminated. The Series 6 exam won't ask you for the exact dollar amounts as they change, but you must know that these limits exist. So what can a high-income earner do? They can often use a strategy called a backdoor Roth conversion. They make a non-deductible contribution to a traditional IRA, for which there are no income limits, and then shortly after convert that traditional IRA into a Roth IRA. While the contribution itself isn't taxable, if there were any earnings in the traditional IRA before conversion, those earnings would be taxed upon conversion. A common trap tested is the pro rata rule. If the client has other pre-existing traditional IRA assets, the conversion's taxability is determined based on the ratio of pre-tax to after-tax money across all of their IRAs, not just the new one. Let's talk about another 5-year rule that applies specifically to conversions. Each conversion has its own 5-year clock to determine if the converted principal can be withdrawn penalty-free before age 59 and a half. This is separate from the main 5-year clock for qualified distributions of earnings. The exam loves to test the ordering of distributions. Money comes out of a Roth IRA in a specific, taxpayer-friendly order. First, you withdraw your direct contributions. These can always be taken out at any time, for any reason, tax-free and penalty-free because you already paid tax on them. Second, you withdraw converted amounts. Finally, last out is the investment earnings. It's only this final layer of earnings that is subject to the age 59 and a half and 5-year holding period rules to be considered a tax-free qualified distribution. To remember the main rules for qualified distributions, use this simple phrase: 59 and a half plus the 5-year path. You need both to get to that tax-free destination. And for the withdrawal order, just remember CCE. Your regular C contributions come out first, then converted funds, and finally, earnings.